Hey everyone, welcome back to Corporate Decoder. Today, A.A.S.P just filed its quarterly report, and I am seeing a massive red flag regarding its ability to stay in business. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is burning through cash and has serious doubts about its future, and that really shows in these numbers. This is a quarterly report, basically a financial checkup for Agassi Sports Entertainment Corp, covering the 3 months that ended on the 31st of March 2026. They used to be called Global Acquisitions Corporation, and before that, they had a few other names. Let's jump right into the balance sheet, which is like a snapshot of what the company owns and what it owes. As of the 31st of March 2026, the company had about $318,000 in current assets. That sounds okay, but look at their current liabilities. They owe over $1.1 million. This is a big problem because it means they have way more short-term debt than they have short-term assets to pay for it. This is what is called a working capital deficit, and as of the 31st of March, that deficit was nearly $874,000. Overall, their total assets were around $627,000. That is not a lot, especially when you consider they have over $1.1 million in liabilities. This is a major concern. And what about their history? This report shows an accumulated deficit of over $42 million. That means that over the years, the company has lost much more money than it has made. Now, let's look at how they performed during the first 3 months of 2026. They had zero revenue. That is right, no money coming in from selling anything. But they still had expenses. Their general and administrative expenses were over $2.5 million. This is a huge increase from the same period last year where they spent about $1.6 million. This led to a net loss of over $2.5 million for just this 3-month period. Compare that to the first 3 months of 2025, where the net loss was about $1.6 million. They are losing money much faster now. Interestingly, the number of shares outstanding jumped significantly from about 9.7 million in 2025 to over 11.4 million in 2026. This means they have been issuing more shares, which can dilute the value of existing shares. Let's talk about cash. This is where things get really alarming. For the first 3 months of 2026, the company used $417,000 of cash just to run its operations. In the same period of 2025, they used about $247,000. So they are burning through cash even faster. They did bring in $650,000 from financing activities, mostly from issuing shares. This suggests they are relying on selling stock to keep the lights on. At the end of March 2026, they had about $317,000 in cash. That might sound like a lot, but considering they are losing over $2.5 million per quarter and have over $1.1 million in immediate debts, this cash pile will not last long. The company has a history of name changes and a significant event in 2016 where they sold off most of their assets to related parties. This made them a shell company for a while, until they made a trademark acquisition in May 2025. This suggests a history of trying to find a viable business model. Their current plan is to create and manage sports content, building communities around entertainment, media, wellness, education, commerce, and charity, aiming to be a leader in racket sports media. They are working on a digital platform called Agassi Intelligence with IBM and also plan to launch a World Series of Pickleball. This is a critical section. The report explicitly states that the company's financial situation raises substantial doubt about its ability to continue as a going concern within 1 year. This is a massive warning. It means the auditors and management are not sure if the company will be around a year from now. It is like a doctor publicly saying a patient is in critical condition. They mention needing more money and planning to raise it by selling debt or equity. However, they admit this financing might not be available on favorable terms, or at all. And if they do sell more stock, it will likely mean a lot more dilution for existing shareholders. In May 2025, they acquired the trademark for World Series of Pickleball. This seems to be a key part of their current strategy, hoping to build a new championship property around it. They are amortizing this trademark over 15 years. Total future amortization expense for this trademark is about $291,000. Looking at their stock activity, they issued a significant number of shares in early 2026 through warrant exercises. On the 13th of March 2026, they issued 80,000 shares of restricted common stock for $400,000, with 50,000 of those going to the Border Lifetime Trust, an entity linked to their CEO. Then, on the 30th of March 2026, they sold another 50,000 shares for $250,000. This shows they are actively selling stock to raise money, and some of those sales are to insiders or related parties. They have a lot of warrants outstanding. As of the 31st of March 2026, there were 2.15 million warrants still out there. These give people the right to buy company stock, and if exercised could bring in more cash but also create more dilution. They granted a bunch of warrants for consulting services to people like George Mackin, Darren Cahill, Justin Gimbelstob, and even Stephanie Graf, who is married to Andre Agassi. This is a common way for struggling companies to pay for services. This section highlights that their corporate offices are in space shared with the Agassi Foundation, provided at no cost. Also, the Burita Lifetime Trust, linked to their CEO, bought shares in the March 2026 private placement. They also signed an employment agreement with their CEO, Ronald S. Burita, with a $240,000 annual salary and a $250,000 sign-on bonus. This shows a lot of activity and financial ties between the company and its leadership. After the reporting period, on the 16th of April 2026, they hired a new investor relations firm, agreeing to pay them $6,000 per month plus over 19,000 shares of restricted stock. Then, on the 28th of April 2026, Investments aka LLC, a company indirectly controlled by Andre K. Agassi bought another 50,000 shares for $250,000. And on May 6, 2026, their CEO, Ronald S. Burita, was granted 300,000 restricted stock units. It seems like they are constantly making deals and issuing stock. This section is management's own explanation of the numbers. They reiterate their plan to build a digital platform and the World Series of Pickleball. They are working with IBM on this platform, Agassi Intelligence, and expect it to launch by the end of the second quarter of 2026. The estimated cost for this platform is quite high, around $2.5 million. The initial cost for Darren AI is about $100,000, and for Agassi Intelligence it is around $2.4 million. They are still in development and beta testing. They again stress the need for future funding, especially to cover payments to IBM, which total over $2.1 million. They are banking on future equity raises, but as we've seen, that's not guaranteed. They confirm no revenue for either period, and their costs are ballooning, leading to increased net losses. This is really the core of the going concern issue. Their current liabilities are more than double their current assets, leaving them with that significant working capital deficit we saw earlier. They have absolutely no comfort there. They are burning through cash, and the only significant inflow of cash came from issuing shares. There are no other major commitments or identified sources of capital apart from hoping to sell more stock in the future, which again might not happen or might be very dilutive. This echoes the earlier warning. The accumulated deficit, the negative working capital, and the dependence on equity raises all point to a very precarious financial position. They are essentially admitting they might not be able to keep operating for much longer without new funding. It is very similar to the situations we've seen with companies like Bed Bath and Beyond or Rite Aid, where they kept struggling to find cash and eventually faced significant consequences. For a company like this, with a market cap of only about $70 million, a serious cash crunch like this can be fatal. Interestingly, the company admits its disclosure controls and procedures were not effective as of the 31st of March 2026. They say they do not have enough people to properly separate duties, which leads to potential issues with completeness and accuracy of financial information. They hope to fix this once they get more funding and expand. They refer back to their previous risk factors, essentially saying everything we said before is still true and probably worse. This is not a good sign. This section details more stock issuances. They converted a promissory note into shares in February, sold shares to the Burita Lifetime Trust, and issued shares to an investor relations firm in April. They also granted warrants to a financial advisor. It is a constant stream of stock changing hands, often on a private placement basis, which is common for companies needing cash. This is the list of all the documents attached to this filing. We see their agreements with IBM, their CEO's employment contract, and the equity incentive plan. It's a lot of paperwork that supports the ongoing efforts to build the business. And finally, the signature from Ronald Burita, the CEO, certifying that the report is true and correct to the best of his knowledge. So, what is my take on Agassi Sports Entertainment Corp? After reviewing this filing, honestly, this report paints a very grim picture. The company has a history of struggling, with massive accumulated deficits and a current cash position that is dangerously low relative to its immediate debts. They are burning through cash at an alarming rate with no revenue to show for it. Their reliance on future equity raises is their only lifeline, but there is no guarantee of success. and any new funding will likely dilute existing shareholders significantly. The going concern warning is the most serious red flag, indicating that even management and auditors believe there is a real possibility the company won't survive the next year. Their partnerships with IBM and plans for a pickleball event are ambitious, but they seem far from generating any meaningful revenue to support these ventures. My biggest concern is the massive cash burn against zero revenue. When a company is spending millions without bringing any in, it is a race against time. I will be watching very closely to see if they can secure any substantial new funding and how that might be structured, as that will be the determining factor for their survival. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like this video if it was informative, comment with your thoughts, and subscribe for more breakdowns. Check the Discord in the description.